Ladies and gentlemen, I am looking for investors and I'm asking for $2 million for 10% stake in my business. Great, show me your latest annual income statement. Here is a copy. We made $20 million in sales last year. Yeah, but you made a net loss of $100,000. This is a losing business. I'm not investing in this. Okay, hold on. Look at our EBITDA. We actually made $200,000 last year. Wait, what? Okay, now I might be interested. Great, but there's more. Look at our adjusted EBITDA. We actually made $500,000. Whoa, what the heck does your adjusted EBITDA include? Well, we're adding back stock-based compensation, which, as you know, is a non-cash item. Jeez, okay, you guys are practically printing money. Let me make you an offer. Oh, that was actually pretty fun to record. But today we're talking about non-GAAP metrics or non-GAAP measures. And as in the name, these are non-GAAP. They don't conform with US GAAP, generally accepted accounting principles. So typically with GAAP, you have sales, and then you reduce expenses, and then you get to net income or loss. But as we'll see here with these measures, there are certain things that we can add back to this net income or loss figure, such as non-recurring items, non-cash items, and a few other things. So let's take a look at the agenda for today's video. We'll take a look at the common non-GAAP measures. We'll talk about how to use them to improve investor communications. If you're someone who has a business that has investors and you want to improve the way you communicate to them. We'll talk about some of the history behind these things. We'll talk about an example of abuse, pretty funny one actually. And then regulation. What are the regulations? Who's governing? Who's policing these things? And then at the end, I'm going to tell you my recommendation on how to use it if you are a business owner or if you work within a finance team in an organization, how to use these metrics or measures to improve what you communicate to investors. So if this sounds good to you, stick around. Welcome back. This is Bill Hanna, the financial controller. I'm a licensed CPA in a great state of New York and working as a corporate controller for the last 18 years. And today's topic is non-GAAP measures. These are things that are heavily regulated by the SEC for public companies, but not so much for private companies. So if you are a private company and haven't taken advantage of presenting some of this information to your investors, this video is going to be for you so you can learn about the different aspects you can present. So the example that we've shown in the intro was a company showing its income statement with a net loss of $100,000, but with an EBITDA, which is adding back interest, tax, depreciation, and amortization, and showing an actual positive number, $200,000. But on top of that, they're showing adjusted EBITDA and adjusting back for stock-based comp. Based on the idea that stock-based comp is a non-cash item, it's just an expense, an accrual on the income statement. So you can add it back and say, hey, if I add that back, I'm actually making $500,000 for the year. Another example is if you look at this income statement, it's showing here the gross margin on top. So this is presentation A and presentation B. On the top presentation, gross margin is 24%. On the bottom presentation, we have the gross margin of 24%, but we're adding adjusted gross margin and adding back 3%. And the way we're doing that is, in this case, this company had a one-time non-recurring item of a write-off of inventory, right? So this write-off of inventory, since it's non-recurring in nature and happens once, that's when you can take advantage of that and say, hey, if I adjust that back, then it becomes 27% adjusted gross margin. I hope that you're enjoying this video and that it's providing you with value. If it is, you should help me out in return and click a like on this video and share it with anyone that you might know who will benefit from this information. And since we're talking about KPIs, and if you've been a listener to the channel for a while, we've recently launched the FP&A Academy. So go ahead and check it out in my website, which is a course that teaches you management and investor presentation, such as this one, alongside all of the other tasks that an FP&A analyst will perform, such as forecasts, budgeting, financial statement analysis, among many, many other things. So go ahead and check it out. But moving along here, the reason for showing these non-GAAP measures 99% of the time is to make the company look good, right? Rarely have I seen, if ever, one of these adjustments to make the company look worse or the financials make worse than what it is. It's always to make the company look better. Management usually gives this information to give a better outlook on the future and a better representation of the outlook on the future. So for the example of adding back the inventory or the write-off of the inventory, adjusting gross margin, what we're doing here, if we go back to that example, what we're doing here, we're showing, hey, even though our gross margin is 24%, we are telling you that our adjusted or gross margin should have been 27%, but because of this one-time write-off, it was 24%. But what you can focus on is that new number, 27%. Let me know in the comment section below what kind of non-GAAP measure have you used before, whether you're a business owner or you work in a finance team. I'm curious to see which kind of non-GAAP measures you've encountered in the past. Go ahead and let me know in the comment section below. In terms of history of how these non-GAAP measures came about, typically they get pushed by someone who's either a CEO or a big investor such as Warren Buffett. In this example here, we have John Malone, who is the first person to push for the idea of EBITDA, earnings before interest, tax, depreciation, and amortization. John Malone is a chairman of Liberty Media, and he's pretty wealthy, net worth $10 billion. But back in the 70s, he pushed for the idea of EBITDA because he was using a strategy to grow the businesses that he was running that leveraged a lot of debt. And when leveraging debt, there was nuances with interest, also nuances with taxes because he was using some of the write-offs of interest to lower the tax liability. So he wanted to show a measure for earnings that reduces all of the nuances of interest and taxes. And so he was pushing for the idea of EBITDA, and that's how that one came to be. But of course, as with every new innovation, you find cases of abuse. So the one case that I found, which was in 2018, WeWork wanted to file to go public and filed S1. And in their filing, they pushed for a new type of measure called community adjusted EBITDA. So they're taking the idea of EBITDA and taking it a bit further and saying, hey, on an aggregate level, our EBITDA doesn't look great. But if we looked on an individual location and strip back some of the expenses that are not necessary to run that location. So for example, if you look at one location, you don't need general and admin, such as the finance and legal team, to run every aspect of the operation. So they strip back some of these costs, add general and administrative sales and marketing costs out of that EBITDA for that location and said, hey, on the community adjusted EBITDA per location, we actually look great, right? So that idea was criticized back in 2018. So every one of those non-GAAP measures will get pushed to its limit by some companies, as you will find. So beside these ones, what are the other non-GAAP financial measures that you typically see? So typically you'll adjust EBITDA for non-recurring items. So items that don't happen often. And the joke here is that I used to have a CFO back in the day that wanted to adjust for an item. And he said, hey, let's go ahead and adjust for this $100,000 item that is an annual one-time item. So when I heard him, the statement didn't make any sense because he's calling it annual and he's calling it one time. So which is it? Is it annual? Or is it one time? Because annual means recurring, right? So this is some of the abuse that you might see here. But if it's not recurring in nature and happens only once, then it qualifies for this kind of adjustment. So an adjusted EBITDA for non-recurring items, this could be an impairment charge to one of the accounts on the balance sheet, a legal settlement, right? A lawsuit that's been pending for many years. You finally settled it. Given that this is not going to recur again, right? This is a one-time in nature. Tax settlement could also be the same thing. Adjusted EBITDA for non-cash items, and the famous one is stock-based comp. Since we're saying stock-based comp is only an accrual on the income statement, there's no real cash that comes with it. You can adjust it. You can adjust EBITDA for that. And there's also free cash flow. Which is operating cash flow less capex, which is capital expenditure. Okay, let's talk about the regulation around non-GAAP measure. So for a public company, the SEC is regulating these things. Believe it or not, the SEC actually gets on the phone and listens to the earning release or the earning call by companies to make sure that A, the management is not misleading investors, and B, that management is being consistent. Right? So consistent meaning you're not saying one thing to one group of people and then turning around and saying something else through a different kind of communication to another group of people. right? So there's a lot of rules around it from the SEC. Things like prominence. So for example, the SEC will look at how you display your non-GAAP measures compared to your GAAP measures on your release. And they want to see that you're not showing prominence more for non-GAAP measures. So they want it to be either equal or less in prominence than your GAAP measures, right? So they want to see GAAP more prominent, and they want to see non-GAAP equal or less prominent. So you're not pushing this information on investors, right? A lot of rules go from the SEC for non-GAAP measures. For private companies, right, this is not regulated. Auditors have some responsibility when it comes to it, but it's limited, right? They only review for reasonableness here. They don't have an actual responsibility to audit these non-GAAP measures. So it's non-regulated, and typically then the recommendation is to stick to common practices. So if you're a business and you want to find non-GAAP measures that better communicate the value or better communicate the financial performance, it's better to stick to common practices, as easy as Googling the industry you're in, and then say, software business, non-GAAP measures or common non-GAAP measures, and finding the results that suit your business, right? Now, as we said at the beginning of the video, we'll talk about my recommendation when it comes to non-GAAP measures for your business or for your finance team if you work at a company. So the first recommendation is to use it 100%, right? The purpose here is to make your financial look better and communicate better information to your investors. So if there is an item that can be added back to your net income or loss that can better communicate what's happening in the business, 100% go ahead and use it, whether it's an adjustment to EBITDA, whether it's an adjustment to your gross margin, or one-time item, you should communicate it and disclose it to your investors, right? You should always, if you're a public company, you should take note of SEC requirements. There are tons of requirements that the SEC put forth on non-GAAP measures. You can go ahead and Google it. You'll find a lot of information on that. If you're a public company, this is heavily regulated because, as you can imagine, the SEC doesn't want you to mislead investors, such as the case that we saw earlier with WeWork, where they tried to push a new kind of EBITDA adjustment, right? You should clearly label as non-GAAP. So any kind of measure that you are presenting that is non-GAAP, and you should consult with your accountant what is GAAP and what is non-GAAP, right? Label that clearly so that you're not misleading anyone. Provide an explanation of the adjustment. So if you're saying adjusting for stock-based comp, explain the amount, and the footnotes explain how much you're adjusting and which line item that's coming from and going to. The more explanation you provide, at least you will seem that you're not misleading anyone. So you have to go ahead and explain as much as possible what you're providing here as non-GAAP measure. And at the end, avoid misleading information. The goal here is to communicate the business performance. And if you feel that your GAAP financial statements aren't doing a fair job at providing a full picture of the business, you should look to non-GAAP measures to provide additional insight into the performance of the business by removing an item or adding an item that is not recurring. So I hope that you liked the video and enjoyed it, and I'll see you in the next one.